You can spend, you can save. What is the right thing to do? Federal benefits, thrift savings plans too. You can save your own way with help from Micah and Tammy. You can save your own way. Save your own way.
Welcome back to the Plan Your Federal Retirement podcast. I'm your co-host, Micah Shalansky, and with me back is the amazing Tammy Flanagan. Tammy, how's it going, ma'am?
I'm doing great, Micah. I'm glad to be here, and we're going to talk about something of interest to everybody today, I'm pretty sure. They may not know they're interested in it, but I think they will be once we talk about it.
Boy, this is one of those topics, Tammy, I think you just nailed it, right? That we have to talk about, that everyone has a little bit of interest on. We might have some predisposition, some negative thoughts about it, right? But it's something we got to talk about because it's so important and part of your retirement plan.
Yeah, it is important. And it's something you really can't hide your head in the sand over, because if you don't do it today, you don't know what's going to happen tomorrow. So there's no time like the present to take care of. This is kind of a little bit of estate planning when we talk about this topic of insurance.
Yes, right. Now, you could have been thinking, man, what are they going to talk about? It's March, man. It's probably taxes, right? Okay, well, we love talking about taxes, and it could be, but no, it is insurance, right? We need to talk about this in this life insurance, not just health insurance side. So before you tune us out, at least hear us out for a little bit. There's things you need to make sure you're considering. And I know, Tammy, one of the things that I always talk to my clients about, and I think you do the same, is look, I'm not biased whether you get insurance or don't get insurance. This is a math question, and you need to understand what you're choosing. And by choosing not to do something, you're making a choice not to have the insurance. Know the consequences of those actions. And sometimes the consequences are negligible. It doesn't matter. Sometimes the consequences could be devastating to the surviving spouse. And just because maybe you're both retired and both have pensions, or you're both retired and you have different income sources, it may not mean you need the same life insurance amount for each spouse. There's been many spouses that one spouse doesn't really need life insurance, but the other spouse does. So we got to be weighing those things.
That's right. I hear people sometimes say, they'll be like, oh, we're both the same age, or my husband's older than me, so he's going to die first. It's like, we don't really know the future, do we? So we have to, I always tell people to say, remember that right now there might be two of us, but someday there's most likely going to be one of us. And so when you think about whoever's the last spouse standing, how is that loss of income when you pass away, or vice versa, going to impact you financially? Will you be able to live in the same house and pay the taxes and the utilities and insurance and everything else it takes to live in that same house? And you might say, well, no, I'm going to move, somewhere smaller. Well, that's going to cost money too. And, you probably want to still keep up your same standard of living. You're going to maybe want to do some things and travel. So you really have to think seriously about, what does it take to live on my own if my spouse passes away? So estate planning or life insurance planning for a married couple is one thing. And then the other thing, I'm sure you get this too from your single folks. Why do I need life insurance? I'm single, just me, myself, and I. So I'm not financially covering anybody else. So do I really need to have any life insurance? So I think those are two of my big questions that I get from people, or different ways of analyzing this.
Tammy, some of the other things that I hear is, well, I'm going to retire, so I don't need life insurance anymore because I'm not working. And that kind of alludes to, well, I don't have an income to replace. And it's like, well, you do though, right? You may not have an working income, but you're going to have a pension, and you're probably going to have Social Security. And when you pass away, what happens to those? What's the survivor going to need from that? Then I know we get another question that comes up, which is like, is FEGLI a good deal or not?
Yeah, because it is a group policy. You get FEGLI when you're first hired. It's easy because you can sign up for it by filling out a little form. And when you're first hired, there's no medical underwriting. So there's a lot to say good about FEGLI. But over time, is it really your best option? So I think that's an important thing to consider, because even though it is group insurance, it does cover everybody in the group, regardless of their health. So you're paying the same premiums as somebody who's, maybe got terminal cancer and signed up for it during an open season. So you've got to take that into account. I always say FEGLI is the best deal in town if you're not insurable.
Mm-hmm.
But if you are insurable, I think you should shop around. I think there might be a better fit for what you need for your life insurance needs.
I agree. And Tammy, just as you alluded to, right, this all starts with number one, your life insurance needs, right? This isn't a rubber stamp that says everyone needs X amount of insurance. Not the case at all. This is your unique situation. How much life insurance do you need, if you need all? And I know, Tammy, the way that I like to approach this with clients is it's super simple. It's not complex. Sometimes it's work because you got to put some stuff in there, but it's pretty simple that if we have Bob and Sue, right? And if Bob passes away, what lifestyle impact does that have on Sue? Does she have enough money coming in to keep her in the same lifestyle she was when they were together? That's the question. Right. And if the answer is yes, that you have enough income, you have enough assets, then great. Maybe you don't need life insurance. But if the answer is no, because again, pension got maybe cut in half because that's the max survivor benefit you could leave. The Social Security check could have gone away entirely. So that's less income to the surviving spouse. If that surviving spouse, Sue in this case, does not have enough money to maintain her standard of living, now we need life insurance even into retirement. What are your thoughts on that?
Oh, I agree. And I always, when I teach this in class, I use myself as an example. It's kind of funny, but it's true. I think of my husband and I'm the spender, believe it or not, even though I talk about money and planning for retirement and saving, I'm a saver, but I can spend money pretty well. And my husband is just the opposite. He's the one that's very, very thrifty. I'm the spendthrift. He's the thrifty one. So I always joke that if I die first, he gets a raise because I stop spending. I spend everything I make and most of what he makes. That all goes away. So he'll just be fine financially. He's got his government pension that's pretty generous after 36 years of federal service. So, he'll be okay. But if he dies first, I'm in big trouble because there goes half his pension, right? Because I only get the survivor benefit. Yeah. I have Social Security, which is nice, but if I can delay it till I'm 70, that will be something to talk about. And then the only other thing left is savings. And so we've saved enough knowing that that's the case with us, and we haven't touched our retirement savings yet, even though we're both past age 65. We haven't needed to because while there's two of us, we're okay. And I'm still working, right? I'm still young enough, a young 66-year-old, that I can still make some income. So I'm not going to touch my savings. I'm not going to take my Social Security in terms of planning for the future. So I don't think that I would need a lot of life insurance if he passed away because I have these other plans in place. But I think that's what anybody has to do is to say, what if it happens? What have we done to plan for that someday event? That can happen tomorrow. It can happen 20 years from now.
Yeah, I'm 100% with you, right? Everyone's situation is a little bit different. I love that you and Brian are looking at it realistically, right?
Yep.
And this is what I like to say with clients. It's not good or bad. It's what's your real situation. And now we need to look at it. I have one client and he's a birder and he likes to spend $20,000 to $30,000 a year on birding. Well, when we're doing the survivor plan, we don't need, if he passes away, she doesn't need that extra 20 to 30 grand. She's like, I'm not doing these trips, right? So that's a realistic thing. But Tammy, the mistake that sometimes I find, and I want your opinion on this, is that clients or people, because insurance can be a touchy subject, they'll start justifying all these things they don't need, but they actually do. They're like, oh, well, it costs us $8,000. Oh, I can't do math right. All right, $8,000, hold your right fingers, $8,000 a month to live. Well, that's two of us. If one of us dies, you know what? She'll get along fine on $5,000 a month. Okay, great. Where's that $3,000 a month going? Well, she just doesn't need that much money, or he doesn't need that much money. I've heard it both ways. Yeah. And so generally, I don't like to argue with people. And so I'm like, okay, great. Well, if that's the case, what I'd like to do, you guys are spending $8,000 a month right now. Let's go ahead and tighten our belts up for the next 3 months. Let's save that $3,000 a month. And you guys let me know how it goes. They're like, whoa, we don't got $3,000 a month to save. I'm like, okay, well, if you don't have that much money to save now, how on earth are you going to do it when one of you passes away? Right. So that's our realistic test that we can do. If you come up with a number and says, great, we can live on less, awesome. Go do that for 90 days. And if you do it, you bank the money, life is good. Okay, you can live on less. But if you can't, then have an honest conversation that says, nope, this isn't that amount of money. We need more. So we might need to refigure our survivor benefits.
And you also have to remember too, that when I was younger, we had 2 children. And even though I had quit my job and I was just starting to do retirement training and that sort of thing, I wasn't making a whole lot of money in the early days. I still went out and bought a big life insurance policy because I thought if something happened to me while my kids were still at home, needing to be cared for, needing all the things they need as they grow up, I didn't want to leave my husband to have to finance all of that on his own. So in my case, I bought a 20-year level term policy when Sean was born, knowing that when he's 20, hopefully, whether he likes it or not, he could be independent by then. So the need for that insurance was going to go away at some point. But you have to think in terms of what you were saying about, planning for that future, but also how those needs change over time. There was a time I did need a lot of life insurance. I don't think I need it today.
Mm-hmm.
Things have changed. My lifestyle wouldn't change much, heaven forbid something happened to him, because these other plans are in place. But I think that's the thing. A lot of people aren't thinking about that what if situation and what are we going to really do? And what are those expenses? Like you were saying, what is that monthly amount that I would need if it's just me?
One of the things my dad did for me when I was 18, which I did not appreciate it at the time, but it was like, all right, I need to put some faith in here, and he knows what he's doing, is he had me buy $1 million life insurance policy when I was 18. And I'm like, I'm single. I don't need this $1 million of life insurance. Like, what are you doing? And he was like, well, are you going to be single forever? It's like, no. Okay. You want a wife, you want to have kids. And at that point in time, the insurance cost is going to be so much more. It's never cheaper than it is today. Go out and get this policy. So he had the foresight to look in there and says, hey, you have this big expense coming, and it's worth buckling down now and paying. In grand scheme of things, right? It was cheap. It was so cheap when I was 18. Now I didn't make any money, so it was a little fun paying for it, right? But it was such a good planning decision, because then when I got a family and all these things, I had plenty of life insurance at that time to make sure my bride and my kids were taken care of. So this is a future thought. It's not just the today thought. So for a retiree, it's that same thing. What insurance do I need today? But what insurance do I need for the rest of my life? And sometimes it's a bell curve, or it's at least a cliff that kind of drops off, right? With a lot of clients, I'm like, hey, we probably need life insurance into retirement. I don't need it till you're 100, but you might need it between 75 and 80. And then God forbid, if something happens to you, then you have enough money left over that you don't need that life insurance anymore. So we got to be forward thinking with this.
That's for sure. And when employees retire, they're kind of forced to think about life insurance, because if they have FEGLI, the government plan, you have to make a decision. How much of that do you want to keep? But in reality, I really think that decision should be made a lot sooner than when you plan to retire. So if you're listening to this and you're in your 30s or 40s, great, because that's the age like you were. I mean, maybe not necessarily 18. Most people aren't doing that, but at 35 or 40, typically you're pretty insurable. You're not expected to die anytime soon. You're generally in good health in most cases. You're young enough that the insurance company looks at you as a low risk. So when we talked about, is FEGLI a good deal before we started the show, for that age group, FEGLI's not a bad deal. It's not the greatest deal. But boy, when you count that price down the road for 20 years carrying FEGLI, when that goes up every 5 years in price, in terms of having a level term policy, you're going to save a ton of money, but you don't realize that unless somebody explains it to you, because you think, oh, it's a group policy, it must be the best deal in town. And it not necessarily is when you think about the future.
Where you're 100% spot on, right? So where do I need to be? And sometimes it's the best thing for today, but then what's the plan? But as we all know, life turns around and really gets ahead of us. So figuring out if you actually need life insurance, figuring out how much you need. And that's just a math calculation. It's not $1 million. It's not 500,000. It's how much monthly income do I need to replace, and how long do you need to replace it for, right? That's where we kind of come up with that math. And then, Tammy, one of the things I want to get into, I know we want to talk about some other stuff, but I'd like to talk about estate taxes real fast, because this is something that I've found, and luckily we've avoided it with our clients, but I get calls from clients being like, hey, my brother-in-law just passed away, a family member just passed away, and now we have these estate taxes to worry about what's happening. And this is something that gets a little confusing, right? We have our federal income taxes, which we all have to pay, April 15th every single year. Then you have state income taxes. If you're in one of the non-7 states, that is a tax-free state, you have the privilege of paying taxes. Tammy and I, Florida and Alaska representing here, right? Those are easy. It's just zero. We love it. But you have state taxes you have to pay on your income. But there's several states that have an estate tax, this is an inheritance tax. If you die and your value of your estate is worth more than X amount of dollars, you have to pay more taxes to the state. Now, the federal exemption is about $12.5 million. So if your state's worth less than that, you pay zero in taxes. If you're married, it really becomes $25 million. Couple of ways to do that, right? But you pay no estate taxes. So everybody's heard this number. They're like, oh, I don't have to worry about it. However, if you live in Oregon, Washington, New York, a handful of other states, they have some pretty severe estate taxes. I'm going to pick on Oregon and Washington for discussion. Oregon is limit is $1 million. So if you have an estate worth more than $1 million, anything above that is 10 to 16% you're going to pay in an estate tax. So add up your house, add up your IRA accounts, right? And then you add life insurance to it too. Someone goes and buys a $500,000 or $700,000 life insurance policy, and they may be missing the fact that depending on how you own it, they may have to give up $70,000 or $100,000 of that policy to the government. So you got to be really careful with this. Does that make sense?
Now, I want to make sure people understand that we're not talking about income tax. Life insurance proceeds are tax-free as far as income tax. But you're talking about a separate tax for estates. And that's something we don't think about much because we think, oh, we only have to worry about that if we're wealthy. Well, you can leave a lot of money behind in this day of high real estate prices and higher salaries, at least. I heard the recent average federal salary rate is over $100,000 now.
Wow. Yeah, I'd buy it.
Now, that's according to one of those career places. So I don't know how valid that is, but I kind of sort of believe it because I've met a lot of clients who are in that range where they're making well over 100,000. So if they're carrying 5 times their salary, 6 times their salary in life insurance, like you said, that's probably a good 750,000
on top of their IRAs, their TSPs, their bank accounts, their house values, right? This number adds up. So the reason I bring this up is this is avoidable. Now you got to be careful. Sometimes it's harder with group life insurance. If you do individual life insurance, Tammy, there's something called, cross ownership, that my wife owns my life insurance, I own her life insurance. And basically the short answer of that is if I died and I lived in Oregon, well, any life insurance that I die, it's in her estate because she owns it. And so I don't pay any estate taxes. So it's very easy to avoid it. But, you got to see this coming. And most people miss that very little thing about how to properly own life insurance. And again, you're in a handful of states, you could end up paying a lot of money that you could have avoided, which is always painful for me.
You brought up a good point about Alaska and Florida. We don't have an income tax. I don't know the answer to this, but I'll bet you do. Do we have an estate tax?
No, ma'am. You do not have an estate tax either. Neither does Alaska.
No, so that's all considered income tax from that point. Good. Very good.
Yep. You have a sales tax and property tax.
You had me worried for a minute.
Yeah. No, actually, I pulled up the list right beforehand just to make sure that Florida was off of it. So no, you're off. It's Hawaii, Illinois, Iowa, Kentucky, Maine. There's a handful of states out there. So if you don't know, make sure you're emailing your financial advisor and be like, hey, am I subject to a federal or a state estate taxes? Let's make sure that all of your money goes to your heirs and not the IRS. Transitioning from that, right, we have the ownership, but also it's probably worth talking a little bit about beneficiaries as well, right?
So with your life insurance in the government, FEGLI, most people will file a beneficiary designation because if you don't, everything's going to go according to the federal order of precedence, meaning it all goes to your spouse, which is what most of us would want if we're married. But then from there, it goes to your children, if living, right? So your children would share that equally. And your children, if one of them passed away, their descendants can get their share. That's how the order of precedence works. And then if you don't have children, you don't have a spouse, then they look for parents if living. Parents are both deceased. Now you've got your estate, your will. So if you don't have a will, is this when probate comes in, or this is when everything, the court has to decide who's going to get the money?
Yeah, it's a good question, right? So a will is a document that helps govern and is governed by probate. Probate is the court-sponsored process for dispersing your assets. So if you don't have named beneficiaries in there, it goes to your estate. And if you have a will, well, then great news. This is when your will should kick in. If you do not have a will, the government has one for you. You may not agree with who their beneficiaries are. So this is what I always encourage a client to get is make sure you get a will, but make sure you have named beneficiaries. And Tammy, I know you and I are not a fan of the defaults. And it says, hey, if you want your spouse to get the money, and if she dies, then if you want your kids to get the money, don't fill anything out. We're not a big fan of that. It's got a space for it. Put your spouse's name on there. Put your kids' names on there. If you don't have any children, you spell Micah, M-I-C. No, I'm just kidding, right? But you got to fill these things out.
And make sure you keep a copy of it somewhere so whoever it is that you've named can find it and figure out that they need to make a claim for that benefit. Because they don't always go looking for your beneficiaries if nobody steps forward to claim the money. So, you should have that strong box or that safe deposit box or some place where you're keeping all these records of your federal benefits, because someone's going to have to figure out what to do with all that when the time comes. I had a pretty close friend pass away last year. He was relatively young, but he had been sick for a long time. And I think he knew that it wasn't going to end well for him. But he did none of that. So his poor sisters, he wasn't married, didn't have any children, didn't have parents living. So the left behind were two sisters. And they're now trying to set up, some way to get this money. One thing with the thrift savings plan, he was a federal employee. She's been on the phone with them at least 6 times and still doesn't even know how much he has in his account. Yeah. So, he didn't leave behind a statement. He didn't file beneficiary forms. What was he thinking?
Yeah.
I thought he had done all. I just assumed, but apparently not. So that taught me a lesson. If I know people that are close to me, I'm going to make sure they have those documents on file, that somebody knows where to find them.
Yep.
Regardless of if it turns out well or not, you've got to be prepared. You don't know what the future holds.
Tammy, one of the things that I found as a financial planner, right? I'm asking clients, do you have your estate planning done? And they say, yes. I'm like, great. Can I get a copy of it? Well, we don't have it signed just yet.
Oh, no.
And I'm like, when did you meet with the attorney? 10 years ago, and I'm like, okay, well, I'm going to say that's not done. So we need to go back and we need to finish this, right? So sometimes we've gone to the nth degree, we've gone to the 9th yard, but we haven't crossed that next line that actually means it's done. And so done is not only is it signed, it's filed, copies are distributed where they need to be. I know every 2 years, one of the things about every 2 years we do for all of our clients is we do a beneficiary report where we list all of the assets that we are aware of, how they're titled, who the beneficiaries are, who the contingent beneficiaries are, and the dollar amounts. And then we go through this with all of our clients, and then they go through and review it and says, is this still correct? And there'll be several times says, no, Mike, I updated this on my TSP. So great. I'm glad you did. We didn't get a copy of that. So I can't update this report until I get a copy of your updated beneficiary change. And sure enough, they never updated their beneficiary. So really important. Sometimes we think we have things done and it's not done.
And sometimes in the government, you don't realize there are 4 different potential beneficiary forms that you might need to keep up to date.
Yeah.
You have one for FEGLI, which we've been talking about. You have one for your retirement, whether it's FERS or CSRS, that's a different form. And then you also have one if you're still an employee for unpaid compensation. Now, the one thing that has changed since 2022 is the thrift savings plan. It used to be you could download the TSP3 and fill it out and mail it in, or whatever you wanted to do there. But now it's all electronic. So you have to go to tsp.gov, access your account, and fill out your beneficiary elections online. And one thing that I didn't realize till recently that has changed, I don't know if you heard this or not, but you can no longer designate contingent beneficiaries on the new way of filing a beneficiary form with the thrift.
No.
So you can't say, to my 2 children and otherwise, to my children's, whoever, you can't do that anymore.
Boy, this is baffling me because I'm going to have to take a peek at that. Thank you for letting me know, because on the TSP form, it will show primary and contingent beneficiaries on the TSP statement.
If you have an old form on file, if you have that TSP3 and you never updated it since 2022, they'll still honor that contingent beneficiary. But if you're filing a new one electronically, you can't do it.
Holy smokes. Have you talked to them? Any update on when they're going to fix that or address it?
It's not being, that's the way it is. They say that's the way it is in many other accounts, not the government accounts, but like bank beneficiaries and other insurance plans. So I don't know. I'll pass that on to you, what I was told from powers that be at TSP told me this.
I would really like to know that. Yeah. Okay. So if that's the case, and you're now listening to this being like, hey, I need to update my contingent beneficiaries, and you cannot, maybe this is where a trust comes in, right?
Yeah.
I hate to kick you out and say spend more money on with an attorney, but just saying if you can't have a contingent beneficiary, then you need to have a trust. Now, this has a massive tax implication under Secure Act 2.0. This podcast just took a left turn, sorry, because of how beneficiaries have to be described as an eligible designated beneficiary or not. So you really got to be on top of things in your trust planning, your estate planning attorney does, understanding how it works with retirement accounts. And what I will tell you in my experience, the vast majority of estate planning attorneys do not understand IRAs and income taxes. Their job is to worry about estate taxes, not income taxes, which could have a huge consequence.
Another thing to add about setting up a trust, I know when we moved from Virginia to Florida, we just had our trust done. We had it all filled out. Everything was professionally done and distributed. Well, the rules are different in Florida. So you had to have another attorney look at it and update it to meet the conditions that would be payable to those same people in Florida. So state to state, the rules can be a little different. You want to go have that trust document checked out to make sure with a local attorney that it's going to hold up in that state. We didn't have to have it completely redone, but there were a few parts of that language had to be changed.
Yeah, it's really important to know. Well, Tammy, we've got just a couple minutes left. Do you want to try to dive into one more thing real quick before we talk about action items?
Sure.
Let's talk about how death benefits are paid out, right? Because there's there's some different options that you have, not only with FEGLI, which is really MetLife kind of writing those checks, but with all insurance companies. So God forbid, loved one passes away. Let's say there's proper beneficiaries formed. Let's say husband passed away and it went to the spouse. She's the beneficiary. What happens with that money?
Well, the money can be paid one of two ways if it's life insurance, especially in particular FEGLI, because FEGLI is really MetLife. MetLife has held the contract since 1954, so it's pretty obvious that MetLife is your insurance company if you own FEGLI. Well, with that, you have the choice as the beneficiary to take a cash payment. They'll just transfer the money to your bank account or send you a check, or you can let them hold on to your money for you in something called a total control account. So it's kind of like a bank account. It does earn some interest, and it makes it so you don't have to make any quick decisions on what to do with the money. So at least you can leave it there for the time being until you decide, okay, I'm going to move it here, I'm going to move it there, and then you write yourself a check, or you can write a check to somebody else. So it's kind of a draft, not technically a bank check, but it works on the same principle. And I know you had told me, Micah, that some of those total control accounts pay a pretty decent rate of interest. So we checked on FEGLI, and what did I say? It was like a little over 2%.
Yeah, a little over 2%, which isn't today's standards. I would not consider that a good interest rate, right? Rewind the clock 24 months.
That was this month, yeah.
Yeah, rewind the clock 24 months when bank accounts were paying 0, then 2.5 sounded pretty good. But right now you should be getting north of 4% in your savings accounts. And if not, there's plenty of good banks online and institutions that you can do that with. So these are one of those things that we need to look at, right? When the money comes in. Biggest thing when money gets paid, I always tell clients, make no big decision. You just lost your spouse. You just lost your parent, right? You are in no emotional state to make big decisions. So I want to punt as many of these big decisions as we can. So sometimes that's using the total control account of saying, you know what, let's deposit the money in there. Let's let it sit for 6 months. Then we can come back and revisit it. That's okay. Right? Don't feel that knee-jerk reaction to start doing things, because a lot of times you're not making good decisions.
No, not at all. Not at all. You don't want to take it and just divvy it up to all your best friends.
We've seen that.
I don't need this money. I'll just give everyone a check for $50,000.
Yep, I've seen that. I've seen it give away to kids, all these other things. And then the person who was distributing all the money didn't realize taxes were due, and then had to go back to the heirs to get money back to pay the taxes. But most of the heirs spent all the money already, and so they didn't have anything for taxes. It can create quite the nightmare. So
it can take literally a year to settle an estate, if not years in some cases where it's more difficult.
Yep.
So yeah, don't spend that money too quickly until you know what all it is you have to pay out as the beneficiaries.
Amen.
Or the heir apparent.
Well, Tammy, this podcast is not just about us having fun and learning new things. It's about action items. So what are some things our listeners could do this week to take more control of their situation, their finances, especially when it comes to survivor benefits or life insurance?
Well, I would say this is the new year, right? We're in a new year again. So you want to make sure that you understand who is your beneficiary. Do you know where those forms are? If you don't, it's time to file new ones, time to figure out who it is. And also, OPM has a really nice little retirement booklet, and they'll give you a new one every year if you ask for it.
Really?
You can get it off of OPM services online as well. And that's going to tell you this is who we have down as your survivor. I had a client recently, his former spouse was still listed, even though he had elected survivor benefits for his new wife. And his previous wife, she had remarried before 55, but yet they still named her. So his current wife might have had difficulty claiming that survivor benefit, seeing that OPM had the wrong name down. So you want to check your documents, make sure they are what you think they are.
Yeah, that's really important. You know what? I'm going to say another one is talk with your financial advisor, your CPA. Do you live in a state that has an estate tax? Are you addressing that in your planning just to make sure? And if you are, the answer isn't, oh, it's fine, I'm under that dollar amount. Really look into it because a lot of states have a lot of different rules on how this is set up.
Yep, you got to do your homework. The other thing, it's kind of a simple thing, but I think there are a lot of people who neglect to do this, is if you move, make sure that the TSP, OPM, everybody knows where you went. Make sure your address is up to date. Make sure your bank information is up to date. I've seen people not get their checks because of that.
Yeah.
And they don't realize what's happening. So you can update your address with all the agencies pretty simply, but be sure to do it. Don't neglect that.
Perfect. Tammy, I think these are great things that we can go into. And where did you say again to get a new OPM retirement booklet?
Retirement Services Online. So if you go to opm.gov, you can access your account there and just go under retirement, the little drop down tab, and it'll tell you how to have an account if you don't already have one.
Perfect. I'd say it's really important. Another one for cybersecurity. Always have an online account when you have an option. One way you're seeing cyber theft take place is if you don't have an account, they're creating one for you. So if you have one, it's a little bit harder for them to get your identity and to change things up. Tammy, this has always been a pleasure. Thank you so much for being on the podcast again. To all of our listeners, make sure you share, send this information. We got some big goals helping another 1 million federal employees with their retirement, and that doesn't work without your help. So make sure you share this. Until next time, happy planning.